Today's video is all about recent changes that might leave you, a homeowner, paying capital gains tax on your principal residence. So what are those changes and what steps can we take in order to avoid that? Normally when you sell your house, if you've made a profit, you don't have to pay income tax as long as it was your principal residence the entire time you owned it, and that's referred to as the principal residence exemption. So what qualifies as a principal residence then? Well, to start, the property that you're selling has to be owned by you either individually or jointly, and you would have had to live in the home at some point during the year. And finally, when you filed your taxes, you would have designated it as your principal residence. That point is extremely important, so we're going to talk about that in a little bit more detail later in this video. Here in Canada, you're only allowed to have one principal residence, and that limit is per family. So if you and your spouse own multiple properties, like a cottage for example, you both must use the same address when you state which is your principal residence. One of you is not allowed to use the cottage. Now, there are exceptions to this rule, one of them being when spouses become separated, for example. So I'll include some links in the description with more information for you. In 2016, CRA started requiring that all homeowners notify them when they've sold their property, and you'll do this when you file your income taxes. If you don't and CRA finds out, then they won't allow you to claim the principal residence exemption, meaning you'll have to pay capital gains tax on any money you've made on your home. Now, in some cases, people genuinely didn't know they needed to do this, and if you bring it to their attention before they find out, there might be a level of leniency. But it is completely at their discretion, and even then, there might still be a penalty. Let's take a closer look. Let's assume that you bought your house for $300,000 and then sold it for $400,000. This would leave you with a $100,000 capital gain that would normally be tax-free. However, if you didn't declare the sale of your home when you filed your taxes and CRA found out, then they would charge you capital gains on that full $100,000. That's equivalent to adding $50,000 to your taxable income. So how do we avoid that? This is Schedule 3. It's one of two forms you're going to submit with your taxes to let CRA know that you sold your principal residence. If we take a closer look at page 3 of Schedule 3, this is where you're going to let CRA know how long was that property or principal residence during the time that you owned it. If it was your principal residence the entire time, you check box 1. The second form that you need to submit with your taxes is the T-2091, and this is where you're going to include more information about that property that you sold. Taking a closer look, this is where you're going to specify the address, the year you bought it, and what you actually ended up selling it for. Ensuring that you submit both these forms will allow you to be eligible for the principal residence exemption. This wraps up our video on how to avoid income tax on your principal residence. If this is your first time to the Independent Dollar, click here so you don't miss any future videos. And if you have a suggestion for a topic, please let us know by commenting below. I've also included some useful links for your reference. Thanks for watching.